and debt. So equity being shares of another company. And this is debt of another company. So there's cost and amortized cost, fair value through net income model, fair value through OCI model, and we'll model to use on questions, so don't worry about that. Then in part B, we're going to look at different impairment models. Incurred loss, expected value, and expected loss, and fair value loss. And finally, we're going to briefly talk about significant influence, where you own 20 to 49%. So passive actually is less than 20%. And then we'll move up to the next one. In Accounting 410 in advanced, you'll cover this one plus consolidation. Okay, so as you learned way back in chapter 3, although it wasn't as clear till you have all of this. And sorry, for consolidation, you're going to own greater than 50%, roughly. Okay, financial asset, any asset that is cash, an equity instrument of another entity, so another company, or a contractual right to receive cash or another financial asset from another party, or to exchange financial assets or liabilities with another party under conditions that are potentially favorable to the entity. So, as we saw in chapter, it talked about all these. Basically, loans and receivables, if external, are financial assets. And then this is specifically, well, it's really the same kind of thing. We'll specifically look at an equity instrument in another entity or to exchange financial liabilities. So where there's debt, or we'll settle it in cash. And it's got to be estimable and that kind of stuff. Okay, so debt investments include investments in government debt, corporate bonds, convertible debt where you can convert it to shares, and commercial paper, which is loans to other companies that can be traded. Equity instruments represent ownership interests in other companies, so shares, preferred shares, or stock. And the methods of accounting for a particular investment depend on the type of instrument, so debt versus equity, management's intent, the company's strategy, and the ability to reliably measure the instrument's fair value. So I just want to talk about some specific things here. So you're going to use cost or amortized cost. Equity, it's almost going to be almost always a fair value method. Management's intent, for example, hold to maturity. Strategy, is it a passive investment? Strategic. And the ability to reliably measure the instrument's fair value. So, for example, if a stock ASPE can use fair value. As for other assets, investments are always investments are recognized and measured at fair value at acquisition. Basically how we measure everything. The price paid to acquire an asset is usually considered to be its fair value. And that's what we're going to work with. Price of a debt instrument is quoted as a percentage of its par or face value. So if you remember, a bond price of 98 times the face value. And the face is usually 1,000. So, for example, cash received for a bond, $100,000 bond, that's the face, selling at 99.5. Cash is 100,000 times 0.995, which is 99500. Yes. So that would be this one. And the premium would be cash 100,000 times 1.02. So you're just taking a percentage, right? This is a percentage. 1.02, you just move the decimals over 2, is 102,000. Okay, so I don't know if you remember that from intro, but you did learn that there. Okay, page 2 then. Three main models of accounting for investments. Cost is debt, amortized cost, whoops, sorry, that's equity, I've got it backwards. Equity and amortized cost, debt. Fair value through net income model, fair value through OCI model. The equity method is for significant influence, not passive. So these three are really the passive investments. Okay, so summary of passive investment models. At acquisition, you can, if we're looking at the cost, measure it at cost, fair value plus transaction costs. At each reporting date, measure at cost or amortized costs. Unrealized holding gains or losses. Now remember, we talked about those in chapter 3. They're an adjusting entry. And now we're actually going to learn how to do them instead of just guessing. There isn't any in the code. And realized holding gains or losses. So when sold, and this is just at year end or quarter or whatever it is, the end of the period, it goes into net income. Now, the fair value methods, which are almost exclusively used in IFRS, and ASPE can use them as well if the stock's trading actively. So at acquisition, for fair value through net income, you measure it at fair value. You expense the transaction costs. At each reporting date, measure fair value. So you write the investment to fair value. These unrealized holding gains or losses go into net income, and same with the real when you sell it. Now, OCI is a little bit different. It starts off the same way, and you write it value the same way. But the unrealized gains and losses, so you haven't sold it yet, you're just writing it to fair value. So this is just writing to fair value at year end. Goes into OCI. So notice the difference here, and we did talk about that, I believe, at 3, not 3 or 4. Let me just go back and change that. Page 1. Should be chapter 4. We did this. 4 or 5. So if you can go back to page 1, and I had chapter 3 here, just put 4 or 5. Sorry about that. Okay, so sorry, back to here. Chapter 4, we did the adjusting entries into net income or OCI. So here with FVOCI, it goes into OCI, whereas here, if it was fair value net income, it just goes net income. Now, the realized gains or losses, you could transfer to net income, which is called recycling, or retained earnings, no recycling. However, IFRS 9 requires no recycling. Okay, so let's get through this and go through some examples, and so it'll hopefully make sense. You've learned bits and pieces of this already in this course. It just wasn't a nice fashion. They kind of threw pieces at you. But they had to review the statements with you first before they could do this section. So it's kind of odd. An odd situation. Okay. Cost or amortized cost. Applied to investments in debt instruments, notes, and long-term loans receivable, which have cash flows established based on contractual agreements. And that's under IFRS as well. But under ASPE, you're also allowed to record certain equity investments that you're holding for the long term under the cost basis. Okay? So generally, it's going to be debt. Sometimes there's a little equity in there for ASPE. So using these models, I mean, you probably already read this, but using the models, investment measured at acquisition cost, as we set up here, plus any direct transfers for the purchase. Investment continue to be measured at cost or amortized cost unless impaired. And we're actually going to learn impairment models at the end of this chapter. Interest that is received during the term of the investment will be interest income. And you use the effective interest amortization method with IFRS. And you have a choice, either the effective interest or straight line under ASPE. So when sold, the realized gains and losses are recognized in net income, as we said up here. So we're going to specify applying it to debt investments because it's more rare to apply the cost method to equity investments unless the fair value can't be determined. You can see your text for an example of the cost model, but generally for the cost model for equity, you just credit your cash for however much you sold it paid. Then you debit your investment. And then you don't touch the investment again. It's sold or impaired. So you don't adjust it every year. So no yearly adjusting entry. I hope that makes sense. It's a nice straightforward one. You probably wish your whole exam was cost. That's easy. Okay, so we're going to look at a cost